Good morning. How many times have you heard about investing strategies like buying big, um, or, for instance, like keeping your investing for a very long time? The internet is full of this sound advice, primarily coming from investors in the United States, and particularly people like Warren Buffett and many others who have been presenting their way of investing a number of times very consistently, and they stressed most of the times these 2 points. So the first one is that one needs to buy something and to keep it a very long time. It is called the buy and hold strategy. The second one is that they do not favor particularly diversification. They tend to prefer buying a smaller amount of companies and to buy a lot of these companies. Warren Buffett in particular is preferring to buy whole companies altogether. So not shares, but really the whole lot. And the question that I asked myself a number of times, and I think I found an answer to those questions, is being me a European investor, primarily a European investor anyway, is that advice always working as well as in the US and in Europe? And the answer is not really, at least not in my observations. And the reasons are the following. So you have to recognize, first of all, that the economic realities in the United States are not the same as in Europe. In Europe, we have a different approach to a number of things. First of all, in Europe, there is a strong preference for stability. Stability means as little risk as possible and as little change as possible. This is what makes an economic situation stable. You don't change much and you don't take too much risks. In the United States, it's quite different. Now, depending on the periods and depending on the circumstances, but in general, in the United States, you have a more friendly approach to entrepreneurship, to changing things, to innovate, to expand, and to take risks in general. Okay, so these are the two big differences between one reality and the other. As a consequence of these differences, which I think everybody who has traveled to Europe from the United States and to the United States from Europe have probably seen, as a consequence of this, when the investing strategy sounds like buy and hold forever, one has to ask themselves what is exactly the advantage of doing that in an economic reality which is, like the European one, rather static. What happens is in Europe, in general, I'm really speaking now in general terms, is that the love for stability and the resistance to change, to innovation, and to take a risk eventually causes difficulties for companies based in Europe to actually grow beyond a certain limit. Because companies find difficult to grow, as growth is actually, let's say, regulated to some extent, and it is quite costly and quite time-consuming for a company to grow beyond, for instance, the national borders. I mean, a company established in a certain country would meet serious difficulties to replicate their success in a different country within the European Union. Yeah? So it is not as easy as it is to replicate a success between states in the United States. In Europe is different. So we have different countries and we have different regulatory aspects, and we have serious costs involved and a lot of complexities when we try to expand a company beyond certain national borders. Let's put it this way. So what happens is, at the end of the day, that many companies cannot really expand beyond a certain level. Because they cannot expand, their growth is quite limited. They cannot really grow physically as what companies try to do in the United States. They tend to remain more or less the same size. The consequence of that is that when we are talking about a buy and hold strategy, referring to a company, as it is proposed by a number of legendary US investors, when applied to Europe, you have to realize, well, I realized that a long time ago, that really the incentive to buy and hold a company is based on the fact that the company is growing. As the company grows, their profit should grow, their share price should grow as a consequence of that, and as a consequence of that, the investor who keeps shares of a certain company for a very long time gets rewarded. This is not really the way it works in many cases, not in all cases, but in many cases in Europe. And you can see that because if you're looking at the difference between dividend payments in Europe and the US, it becomes rather obvious how, for instance, European companies are paying in general more and better dividends than companies in the States. The level of dividends is higher in general, and many companies pay dividends. In the United States, it's the other way around. In the United States, a few companies pay dividends, and those who pay dividend, on average, do not pay as much as the same average in Europe. Why is that? Well, quite simply because as European companies find difficult oftentimes to grow, the only way they can really reward their investors is by paying dividends. They cannot offer a growth as such in terms of profitable opportunity for investing with them. They need to pay dividends to attract investors. In the United States, the accent is more geared on a growing company, an innovating company, a company that changes and takes risks. Okay, so they don't need to pay dividends oftentimes simply because they can offer their investor the ability to follow a company which is growing, which is expanding. So in that respect, the buy and hold strategy that is proposed by so many legendary investors in the United States doesn't necessarily work very well in Europe, because as a company doesn't expand, doesn't grow, keeping a company for a very long time doesn't make much sense. Let's put it in this way. There is no growth involved, or very little growth involved in general. This is a very generalized terms that are applicable to most situations. So what happens in Europe versus what happens in America is typically that if you look at the share price of certain companies, you will probably see a trading range in Europe and a trending range in the US, reflecting in the US a stable growth, which is reflected in the share price. We tend to go up, whereby in Europe, because of the enamorament for stability and lack of risk and lack of change, you will see that in general terms, oftentimes the share price of companies tend to remain relatively stable. Again, with a few exceptions, but relatively stable. And what companies do is as I said before, to issue dividends to compensate for the lack of growth. But if you think about this difference, okay, buy and hold in a growing environment makes sense because you buy a company which is relatively young, is relatively small, share price is say $10 a piece, and after 5 years this company doubled in size and the share price is 20, 30, 50 a piece. The growth element is a very important element in the evaluation of companies. In the US, the growth element is present. In Europe, a bit less. Oftentimes, a bit less. So buy and hold a European company, expecting it to grow, is probably not going to work very well because growth potentials are limited. From a dividend perspective, which is really the reward you can expect to have from a European company most of the times, it doesn't really make sense to keep a company for many years since profits dictate the level of dividends that company can afford to reward their investor with. And since profits are variable depending on the time, depending on the circumstances, from a European perspective, investing perspective, it makes often more sense to trade companies depending on the expectations of profit they have on a quarterly, semi-annual, annual perspective. But to keep the same company for many years means basically that you buy them at 10, it can go up to 50, then it goes to 40, then it goes to 60, then it goes to 20. There is no trend, oftentimes, to be found in many European companies, and no growth, or very limited growth. So this is one of the big differences between the two realities that I noticed. And you might have a different view on this, which is fine. It depends very much, what kind of companies we're talking about. I'm talking about the companies I normally follow. But of course, there are a number of different situations. The other aspect which I noticed has to do with the buy big and a certain resistance to diversification that I noticed in several cases coming from legendary investors in the US. Particularly Warren Buffett has proposed several times that if an investor needs to diversify beyond a certain point, that means he or she doesn't really know what he or she is doing. Because if you find the right company, you buy a lot of that company and you just wait for it to do its magic. Now, this buy big and lack of the diversification is also coming, in my opinion, from the growth dimension we were talking about before. So, of course, if you are in a situation where you can imagine a company will be growing consistently in the coming years and will expand its activities and will make increasingly more money every single year, of course it makes sense to buy as much as possible of that company. It is perfectly correct. Within that economic dimension, it makes sense to do so. But if you're in a different economic situation, if you're in a situation where growth is limited, where expansion is limited, when change and risk-taking is quite limited, to buy a big portion of a company which most probably will not grow that much, not because they can't, but because there are limitations which are really coming from a certain policy, a certain economic policy, a certain economic vision within Europe in this particular case, then buying a lot of a certain company doesn't make much sense because you will get from that company lacking growth and expansion more or less the same results and you would get from most other companies. diversification within a European perspective makes sense because, first of all, it reduces the overall investing risk. One company is going bust. It's not so bad if you have 50 of them in your portfolio, but if it is the only one you have, it's a big problem. And because, in fact, all in all, there is a lack of a real trending situation within Europe, buying big and keeping companies for a very long time does not necessarily work as well as in the US. Now, having said that, of course, there are situations where there are comparable stories between the two economic situations, so between the US and Europe. There are certain companies that experienced growth also in Europe, but they are very hard to find. And because of the policy, because of the economic view, and preference in Europe, counting on growth, company growth, is quite difficult. So from an investing perspective, the message is, at this time, I would be wary, if I were in you, when listening to certain advice, listening to certain best practices, listen to certain ideas coming from people who are completely qualified to express those ideas. These are multi-billionaires. They know what they're talking about, absolutely. But the question I would ask myself, and I did, is if those lessons are applicable one-to-one to all possible investing situations, including, in this case, the difference between US and Europe. But you can probably ask yourself the same question if you're based in Asia, or in South America, or in Australia, or wherever else you are. Are those big lessons, are those clear messages applicable as they are to the situation I am in as an investor today? And I think many times you might find out that that's not the case. There are nuances, there are differences, and there are limitations to how well a certain approach works between one reality and the other. Well, that's it for the moment. Thank you very much for your attention. If you're interested in knowing more about these ideas, these observations, please feel free to subscribe. And until next time, bye now.